Portfolio allocation. So there are several assets that could go into a portfolio, and I prepared a little list of these possibilities. So starting from cash, which has no risk and also no return. Then comes the short-term U.S. securities. In financial literature, we refer to them as risk-free securities. You have a very little return with these, and according to the financial literature, no risk. Short-term usually refers to these notes or bonds that have a maturity that less than 3 months. But for our purposes, I think that what we refer to is less than a year. Longer-term U.S. Treasuries do have um, interest rate risk, market risk, but because they are U.S. Treasuries and U.S. never actually defaulted on their um, promises, debt promises, we consider these default risk free. However, longer term, because it's a longer term, it actually has market risk or interest rate risk. Meaning, if you were to buy a 30-year bond and lock yourself into a 3%, and a few years from now, market rates increase to say 5 or 6%, then you will feel that you've lost opportunity cost or opportunity profit because you could have actually earned 6%, but you locked yourselves into a 3%. So this is referred to as market risk or the interest rate risk. But we still consider them to be low risk because of the no default risk stipulated with these. Then we have higher risk bonds. These usually referred to as bonds issued by corporations. The term higher is higher than US Treasuries. So there is some risk inherent with these. However, they're still considered to be investment grade. Uh, you know, bonds issued by large market capitalization corporations, agencies, and perhaps some municipalities. Then we have what's referred to as junk bonds. These are the bonds that are issued by um, companies, and these risks, well, risky companies, and these risks are considered to be um, high risk, high return, and not investment grade, and they're referred to as junk bonds. Then we have, in the spectrum of investments that go into our portfolio, we have hybrid securities such as preferred stocks. Preferred stocks are considered to be very high risk because the company has the choice of not paying the dividends. And the only reason that any investor would buy into a preferred stock is to receive the dividends or the coupons. And if the company does not pay these dividends, we cannot force them into bankruptcy because they are not, although they are making a promise, it's not a legal and binding um, promise that they will continue paying these dividends. With a preferred stock, they could stop making these dividend payments, which would drive the preferred stock price to very low levels, even almost zero. So we refer to these hybrid securities, and they're considered to be very high risk. Um, then we have, within, again, our portfolio allocation, we have investment choices that involve equities. Um, I've written down relatively lower risk equities relative to U.S. Treasuries or relative to, anything that's, that comes before these investments. Um, Traditionally, larger cap companies, blue chips, companies that are considered to be um, low volatility fall into this category. And then relatively high risk investments or equity investments, these refer to recently tech companies that have very little assets and very high volatility, um, but potential for growth and therefore potential for a higher return. Then we have high risk equities. These may refer to penny stocks, definitely not investment grade, pretty much like a lottery investment, if you will. And and any portfolio will have an allocation into these individual investment categories. Now, we are referring to a financial portfolio. So if you're talking about a personal financial portfolio, then you may want to include such things as your real estate investments or your retirement investments, commodity investments such as gold, precious metals, precious stones, and things like that. Um, Consider, however, investing in commodities in the financial sense and investing in commodities in um, personal sense may have a significant difference. So, if you're going to be buying gold, um, buying, for instance, um, so let's take a look at Yahoo Finance. There's an ETF for gold, so GLD. So this would be investing in an actual gold, and right now it's $120.36 per share. But when you were to buy the actual gold instead of the ETF, then you may be paying for labor of the gold and not the actual gold, and therefore price of resale may be significantly different than your purchase value. So uh, what we refer to as a financial portfolio is perhaps the securities that you could buy through the brokerage company that you have your portfolio at. Now, there are choices that we make. Should we invest in individual securities or should we invest in mutual funds or ETFs? Now, individual securities may have high risk and perhaps high return. Um, some people prefer to invest in individual securities because they have a special knowledge about the company, some expertise about the companies or bonds. Um, but let's review this choice of investing in individual securities versus mutual funds or ETFs. Now, if we choose to invest in bonds, but individual specific bonds, then most of the time this investment will involve a few $1,000s at least, and you may end up investing 10,000, 20,000, or upwards in a single issuer specific bond. Now, this may be high risk because if that bond goes default, then you lose all your investment in that specific bond. For instance, one of my favorites, which is a very high risk, but Argentina has a 100-year bond that pays about 10%, and I really do like it, but that's my personal choice. And last time I wanted to purchase it, the minimum amount of investment was $5,000. Now, if Argentina goes default, which they have done in the past a couple of times, then I would lose the entire $5,000. If I wanted to invest, say, $100,000, well, it's a great idea to me because I'm actually getting 10% a year. However, the entire $100,000 I would lose if Argentina were to go default again, like they did a couple of times in the past. So it may not be the best of ideas to invest in individual bonds. However, having said this, if you're going to be investing in bonds through an ETF, then you're paying a management fee, most of the time about 0.5%. Now, let's take a look at a couple. If I were to invest in, say, ELD, which is an emerging markets ETF, has an expense ratio of 0.55%. And if you look at their holdings, what you're going to see is they have Indonesia, Brazil, Colombia, and so on and so forth. So I may actually find an ETF that invests in Argentina, and that way I would be diversifying my risk of emerging markets bonds while still earning significant returns such as 8.38, 8.75, with Brazil 10%, and so with Colombia 10%, and so on and so forth. However, at the expense of 0.5%. Now, I don't have to put $100,000 into this or $5,000 into this. Each one is right now trading at $33.51. So there are pros and cons of investing in individual bonds or an ETF. Another nice thing about investing in individual bonds is that you get your coupons quarterly to your account. On the ETF, you actually get your dividends monthly. So, for instance, if you were to look at the historical data and then you look at the dividends only, you'll see that this specific particular ETF pays about 15 cents each month. So, pros and cons. Now, individual securities such as stocks. Now, in every portfolio, I'm sure everybody has some sort of attachment to some company. To me, for instance, one of the companies that I personally like is Apple. Now, it is a company that relatively risky. It's a tech company. It's one of the larger companies. I like their products. They pay a decent amount of um, dividends, about 1.5%. The price is volatile, but I do believe that I like the company. Um, Again, this is just my personal choice, and I do feel personally um, nice about Apple. However, investing in Apple, if you look at, say, 1 year, you can see that the price actually went all the way to 225 and all the way down to 150. That's a very high volatility. So yes, it has recovered some, but it has came back down a little bit. So do we want to invest in these individual assets? For instance, let's take a look at, say, ATVI. Now, ATVI is Activision Blizzard. It's a nice company. They do make um, games as far as um, I remember. So let's take a look at their profile. So content serves on video games, right? So if you look at their price action, that's actually quite scary. Their price went all the way down to $83, and right now it's at 43. So if you invested at this peak point, you've lost half your money by investing in this individual stock. Now, not every stock is this scary, so people may choose to invest in individual stocks. However, if you were to go with the ETF route, then they provide us with a certain level of diversification. For instance, if you wanted to invest in the overall market, the S&P 500 ETF SPY provides us this diversification in 500 different stocks at the expense of 0.09%. We are still taking market risk. However, we are not taking the corporate specific risk inherent in investing in individual stocks. Now, because this is a lower volatility, well-diversified portfolio, the return obviously will be um, somewhat different to investing in individual stocks. Investing in the market supposed to be lower volatility and lower return, and investing in individual stocks supposed to be higher risk and higher return. Um, Through investing in ETFs, you also get this diversification through different industries. So, for instance, if you wanted to go with QQQ, this is the um, NASDAQ top 50 as far as I believe ETF. So, investment seeks investment that generally corresponds to pricing the performance of the index. So Nasdaq 100 index is the QQQ. So if you feel like investing in smaller companies, more of the tech companies, then QQQ ETF would be the ETF instead of investing in individual assets. Or for instance, DIA that gives you the opportunity to invest in Dow Jones Industrial Average ETF. The expense ratio, however, is still 0.17%. It's very minimal, and it gives you a good, nice diversification. So perhaps you may know, at Loyola, we have a student managed investment fund. And in this fund, we have about $1 million. And I wanted to provide the allocation that we have in that portfolio. So we have about 2% cash that provides us with the opportunity to take short-term investment opportunities, our liquidity needs. Then we have about 70% in US short-term treasuries. Now, our current semester students feel relatively nervous about the volatility in the market. the current level of volatility, and therefore they opt to have as much in U.S. Treasuries as possible. Now we locked ourselves into about 3%, 2.86% for 1 year, which these will mature at the end of September 2019. So at that time, with the new class coming in the fall, we'll talk about how much more of an allocation or how much less of an allocation we're going to have into this. Now, 50% of this is in actual bonds individually, and about 20% of this is in a ETF called SHY. Now, SHY is the 1 to 3 year Treasury bond and has a very small expense ratio. And the reason that we invested in this instead of individual bonds is you could easily sell this without incurring the bid-ask spreads on these individual bond investments. So if a student has a presentation and the entire class decides to invest in a specific company, we could sell our investment in the SHY and then use the cash to buy individual equity investments. So basically, we're parking some of our money in the SHY. That's about 20% of our portfolio. We're earning significantly less. The yield is about 2% on this one, whereas individual U.S. Treasuries are earning us about 2.86%. We don't have any long-term U.S. Treasuries simply because the yield curve is pretty flat, and therefore we don't feel comfortable locking ourselves into a 3% 10-year bonds or 4% 30-year bonds. We believe that interest rates will go higher, and therefore, buying into a long-term U.S. Treasuries would expose us in significant market and interest rate risks. We have high-risk bonds. We don't have any corporate bonds, but we have some emerging market Euro bonds. However, we did not buy these individually. We bought them through ETFs. So we had the ELD, we have EMHY. EMHY is also a emerging markets high yield bond with holdings in countries such as Argentina, like the one that I told you before, Brazil, China. I think this is also Brazil and so on and so Ecuador and so on and so forth. So 10% of our portfolio, about $100,000, is invested in emerging market bond ETFs. Then we have about 5% of our portfolio, which is significant if you consider it. It's about a $50,000 investment in preferred stocks, and that's pretty risky. However, we have it into an ETF called PFF. Now, PFF is an ETF of preferred stocks. So while we're taking a significant risk, we are taking a diversified risk, and therefore we are reducing that preferred stock risk of individual assets. So these are the holdings of the PFF. We have companies like Bank of America, Citigroup, JP Morgan Chase, and GMAC, and so on. We have relatively lower risk equities, at least is what we consider it. We have Apple. We have companies like Netflix. We used to have Boeing, although Netflix, I'm not sure if that would be a relatively low risk. It's a high market cap, but it is considered to be a high risk company. And then we have relatively high risk equities such as ADVI. We don't have any pink sheets or any other what is considered to be the highest or extreme risk equities. So that is our portfolio allocation at Loyola University's College of Business Student Managed Investment Fund. And with respect to these allocations, every individual or an institution will have their choices with respect to how much risk they want to take and how much return they want to earn. The lower the risk, lower the return. Higher the risk, higher the return. However, just because it is the higher return, I know it becomes tempting, but just like on the example of the ATVI, the potential of loss could be significant, and your entire savings or entire portfolio could be wiped away with taking such high volatility. So that's it for portfolio allocation. Thank you.